and they're right. But we have here a line in the sand here, a pivot point. This is the point of the 2015 low in the ratio, and we're about to break through it again. We have knocked on this number many, many times. 1, 2, 3, 4, 5, 6 this is the seventh time since 2022, and we're going to break through. And once we break through, I think we're going to be on a multi-year, if the monetary system lasts out, it will be in a multi-something. It'll be a long time where gold is going to outperform stocks. And once that happens, more and more people are going to pile in.
Endgame investor Rafi Farber notes that despite gold doubling since its 2015 low, it has underperformed the S&P 500, keeping mainstream investors focused on equities. However, the gold-to-S&P ratio suggests that this trend may soon reverse as gold approaches a critical resistance level set in 2015, potentially signaling a shift in favor of gold. As Dhanteras approaches, gold buying is gaining momentum. This year, the yellow metal is shining even brighter. With prices hovering near all-time highs, gold has emerged as one of the best-performing asset classes since Diwali, delivering a substantial 32% return compared to the S&P BSE Sensex's 25%. Amid global economic and geopolitical tensions, gold's remarkable performance reinforces its status as a safe haven asset. Silver has fared well, yielding returns exceeding 35% over the same period, with both metals outperforming most other asset classes this year. Gold has surged over 33% in 2024, and with its recent outperformance against the S&P 500, analysts who previously dismissed gold are now recommending holding bullion. Farber suggests that if gold breaks through the critical level, it could herald a multi-year period where gold outpaces stocks, drawing more investors as they recognize that their stock-based portfolios may be losing value in real terms despite nominal gains. As October came to a close, gold reached another all-time high of $2,800, though profit-taking led to a slight decline of $50, resulting in a 3.4% gain for the month. This consistent strength in gold prices, despite a rebounding US dollar and rising treasury yields, underscores its appeal as a reliable investment amidst a turbulent economic landscape. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
Why nobody cares about the gold run and why that changes soon. This is a chart of the gold to S&P 500 ratio. So you see here a few things I wanted to point out. We see a head and shoulders bottom here with the head at 2022 over here where I'm circling and the shoulders at 2018 and 2024. Head and shoulders bottoming pattern, and we have broken through both the 50-week moving average and the 200-week moving average, and we have a golden cross, which I think I pointed out last week. The blue line, the 50-week moving average, is crossed above the 200-week moving average, excluding 2020. This is the first time that this has happened since 2001. I pointed that out last week, but the point here is that the reason that nobody cares about the gold run, by nobody I mean the mainstream, they don't care about the gold run, is because since 2015, look here, 2015, I have this highlighted. The low in 2015, the ratio was 0.503. We are now at 0.44. So despite gold's bull market since 2015, at 2015 it was at 1054 low, I think, and now it is at 2760. So it is more than doubled. Gold is more than doubled, but it's still underperformed the S&P 500 despite that. And it's very frustrating for gold bugs and the stock stackers. Can you stack stocks? Well, let's just call them the bubble chasers. They are saying, and rightfully, that the stock market, S&P 500, has still outperformed gold since then, and they're right. But we have here a line in the sand here, a pivot point. This is the point of the 2015 low in the ratio, and we're about to break through it again. We have knocked on this number many, many times. 1, 2, 3, 4, 5, 6 this is the seventh time since 2022, and we're going to break through. And once we break through, I think we're going to be on a multi-year, if the monetary system lasts out, it will be in a multi-something. It'll be a long time where gold is going to outperform stocks. And once that happens, more and more people are going to pile in as they realize that in real terms, their portfolios are evaporating, even if their dollar amounts are rising, because their gold ounce amounts.
Rafi Farber notes that if the Federal Reserve resumes printing money due to declining reserves, silver could experience a significant upward movement, presenting challenges for stock investors who may see considerable real value losses. Historically, silver tends to lag behind gold during the early phases of a precious metals bull market. In the last bull run, silver surged by 1,000%, reaching an all-time high of $50 per ounce in April 2011. Silver recently tested a critical 12-year resistance level at $35 and has already risen over 40% this year. Recent liquidation of short and medium-term bullish positions in the $32 to $35 range may allow long-term buyers to enter the market decisively. This strategic shift could set the stage for silver to aim for a new all-time high, potentially eclipsing the $50 mark by the first quarter of 2025. Let's get back to the interview.
The short-term silver technical picture is this. Here is the trend line since August when we were at 26. Now we're at 32.80. We're still above that trend line. We would tag it here at about 32. We're also at a support zone, which we hit in September and October as resistance, and also in May as resistance of about 32.80. We'll see if we bounce here. Silver can be very volatile, and once the Fed turns, once the reverse repos run out and the reserves go down and then they have to print more, silver is going to turn around violently, and it's going to be scary for stock market stackers because they're going to start losing real value quickly. The bigger silver picture here, technically, is that we have a line. I forgot to draw it in here. I did draw it in, but it's not here. I guess I put the wrong picture in. But we're at this resistance line of 35. You can see it's the same area as was resistance from 2011 to 2013 before the bear market really started. So we're at that point here. So the fact that this is resistance again is not particularly surprising to expect to slice through this very old resistance all the way back from 2011 is pipe dream thinking, but we will slice through it. It's going to take a little bit longer, maybe a few weeks, maybe a month or two. Maybe it'll be timed with the Fed turning around after the next banking crisis. We'll see, but it's close at hand. QT has slowed by 37% since June. You can see here the numbers that I put in. At December, the balance sheet was at 7.7 trillion, and 22 weeks later, when the Fed started to slow down QT, it was at 7.284 trillion, and now it's at 7.013 trillion. So the rate of decline in the balance sheet is down by about 37% from these 22 weeks to those 22 weeks. They have slowed it down, but they have not slowed down the percentage of dollars that are being backed by literally nothing, and that is the back-end mechanism of what hyperinflation actually is, when the assets of a central bank are worthless that back the liabilities, which is the currency. Bank reserves are steady. These are the reserves, the extra dollars, that if they fall below 3 trillion, we should be at the next banking crisis. You can see here the red lines, all point to month ends when bank reserves tend to fall. And they probably will fall this month too. The numbers will be in at the end of the month. This data is good until October 30th for Wednesday. And it could be a very violent drop given how much money has been vacuumed out of the system thanks to those treasury auctions that cleared last week.
The current landscape for gold and silver indicates a potential shift in investor focus as traditional asset classes face increasing volatility. With gold demonstrating strong returns and nearing critical resistance levels, there is growing optimism that it may soon outperform the S&P 500, prompting a reevaluation of investment strategies among mainstream investors. The recent performance of both gold and silver highlights their roles as safe haven assets amidst ongoing economic uncertainty and geopolitical tensions. As we approach significant buying occasions like Dhanteras, the momentum in precious metals could further solidify their appeal, especially if historical patterns suggest a potential surge in silver prices following a bullish trend in gold. This evolving dynamic presents an intriguing scenario for investors who may need to reconsider the balance of their portfolios, particularly if inflationary pressures and currency devaluation continue to erode the value of traditional stock investments. Given the recent trends in precious metals and the potential for a shift in investor sentiment, how should investors approach their asset allocation in the coming months to maximize returns while managing risks? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.